金暴雷了。
Gold went under. Yongqun Gold has been exposed, with the involved amount reaching 2 to 5 billion. One victim's family saved over 20 million across 3 generations and invested it all, only to lose it all. The gold boss hasn't been caught. They are already in a mansion in the US, living it up with brandy in hand.
Recently, China's well-known internet plus gold plus finance investment service provider Yongqun Holdings was exposed when multiple stores suddenly closed, leaving tens of thousands of investors in a panic, unable to seek compensation. The police filed a case against Yongqun Holdings for allegedly illegally absorbing public deposits. Initial investigations reveal that this is a large-scale fundraising scam disguised as a gold investment scheme. The actual controller of Yongqun, Wang Guhai, is rumored to have fled to the US, and the stores have begun closing gradually since May. According to Chinese sources, this case involves more than investors, with an unpaid amount of about 1 billion RMB. The total funding gap could reach billion RMB, including principal and promised returns. It is the largest financial platform explosion event of so far. The most controversial aspect is that the collapsed Yongqun Gold had once been promoted in advertisements by the Chinese state media CCTV, which further fueled the public's misplaced trust and stirred up public opinion. Recently, an announcement circulating online claiming, starting from June, batch payments for investments below RMB will be made has also been confirmed to be fake information. Reports said that on June, dozens of victims gathered in front of the Hangzhou city government to protest, but they were forcefully suppressed and dispersed by the police, with some facing punishment and even detention. Meanwhile, many investors have continued to speak up in various online rights protection groups demanding compensation and accountability. According to the company's official website, Yongqun Holding was established in 10 with a registered capital of 1 million RMB. According to multiple mainland media reports, over the past decade, Yongqun Holding has opened more than 10% stores nationwide under the Yongqun Gold brand. However, on May this year, the HJO Police Bureau suddenly issued a case notification stating that personnel from Yongqun Holdings were suspected of illegally absorbing public deposits. On the day of filing the case, the freight elevator passage at Yongqun Holdings headquarters in Handur was blocked and seals were placed on the doors. On May, the Hangzhou Commercial District Market Supervision Bureau also listed Yongqun Gold's parent company and its subsidiary on the abnormal business operations list. So, how did Yongqun Gold win the trust of so many investors and successfully collect large sums of money? Many victims' interviews stated that they trusted Yongqun Gold mainly because friends repeatedly recommended it. A victim's family member from Hai Shandong said that Yongqun salespeople often visit their homes carrying gifts like rice, flour, and oil, promoting so-called high-return gold products. In addition to frequent gift-giving tactics, Yongqun Holdings in the past decade consistently paid high returns on time, regularly depositing both principal and profits into investors' accounts, creating the illusion of safe, no-risk investments. This apparent stability led many business people, state-owned enterprise employees, and elderly individuals to trust it completely, pouring in more funds and continuing to invest even more deeply as time went on. What's even more shocking is that in order to gain the trust of investors, Yongqun displayed insurance policies co-insured by multiple insurance companies, including Z-King Insurance, People's Insurance Company, and Taiping Insurance, claiming that the insured amount for the gold assets was as high as billion RMB. Moreover, Yongqun Holdings had previously claimed that it was a council member of the China Gold Association, a partner of the Shanghai Gold Exchange, and an outstanding financial enterprise in Jie Province. These seemingly authoritative official backgrounds, combined with years of operational history and a nationwide retail network, made many investors believe in Yongqun Gold and invest large sums without hesitation. In fact, as early as the end of the issue of Yongqun's delayed payments began to surface, The delivery period of gold bars, which originally took 1 week, was extended to month, and the T+ settlement also began to experience frequent delays. By the beginning of the internet, investors were already reporting difficulties in withdrawing funds. In May of this year, as gold prices soared, a large number of investors tried to liquidate their assets for profit, triggering a run on the company. On May end of this year, the company's financial chain completely broke down, and the payment crisis exploded in full force. By May, many investors discovered that the assets they had stored with Yongqun Holdings could no longer be redeemed. Many victims recall that when they angrily reported to the police station, they initially thought they had lost the most money. But, to their surprise, they saw many others there who had lost 4 to million RMB, or even more than million RMB. As the number of victims grew, they gathered together and identified more questions. How did Yongqun Holdings suddenly collapse? Had they already moved most of their assets? Should the insurance companies that once insure their gold business now take responsibility? What worried investors the most was whether the gold custody that Yongqun had long claimed actually involved real gold. Were the gold bars they bought, they owned, real physical assets, or just virtual numbers in an app? Was this in fact a full-blown Ponzi scheme? In reality, Yongqun's so-called sudden collapse did not happen overnight, but was the inevitable result of a long-standing fragile financial chain and accumulating risks. The root cause lies in the use of a typical Fundpool model where new investors' funds were constantly absorbed to pay the principal and return to early investors, essentially engaging in robbing Peter to pay Paul. To draw in more customers, Yongqun promised high returns and guaranteed profits, which increased its financial strain. By May, a surge in gold prices triggered a mass withdrawal, and the company couldn't keep up. To make matters worse, its inventory was revealed to be fake, with so-called gold reserves actually being gold-plated copper bars. What appeared to be a sudden collapse had actually been years in the making, concealed by layers of deception and continuous siphoning of money. Based on the clues disclosed by the media and victims, it's clear that Yongqun Gold had already transferred most of its assets. Some funds were diverted to high-risk investments like stocks and futures, which may have already gone bankrupt. The rest were transferred through overseas accounts or affiliated companies, and their whereabouts remain unclear. Investigations show that several months before the explosion, Yongqun's executives frequently traveled abroad and began selling off personal real estate. With the so-called large gold reserves were likely just a smoke screen to deceive investors, with most of the funds already transferred or embezzled. As for whether the insurance companies that insured Yongqun's gold business need to bear responsibility, this requires further distinction. Many investors mistakenly believe that having insurance guarantees safe and profitable returns. In fact, this is a major misconception. Most of the policies provided by Yongqun were property insurance or logistic insurance, which only cover losses during transportation or storage and do not cover operational risk, investment losses, or company closures. If the policies do not explicitly guarantee the return of investors' principal and profits, the insurance companies are not liable for compensation. Currently, several insurance companies have publicly stated that their coverage responsibility is limited and that they are unaware if Yongqun actually held sufficient gold assets. So, even if investors file lawsuits, determining responsibility will be extremely difficult. Reports have mentioned that the company even used gold-plated copper bars to deceive customers into thinking they were real gold. The so-called custodial gold was in many cases merely virtual numbers in the app's back end, and investors never saw any physical gold. This is a classic scam model. First, real gold is used to build trust. Then, virtual assets and high returns are used to continuously entice customers to invest more funds. So, the vast majority of investors only receive a string of numbers in the apps, or a so-called virtual holding certificate. Only a few could redeem some gold bars after making an advance appointment. Some of these gold bars were real, but the quantity was very limited, and the withdrawal period was continuously delayed. By the time gold prices surge, it was almost impossible to cash out. However, the fundamental cause of this large-scale gold explosion event is not how sophisticated Yongqun gold scammy methods were, but rather the lack of supervision behind it. It is the complacency of the government and departments that allow the scam to breed and spread for so long. The Yongqun gold scam lasted for more than a decade, with oversight essentially non-existent. Simply explaining this as negligence is hard to believe. Although there is no direct evidence, the fact that it was able to operate illegally for so long without being investigated exposes systemic regulatory flaws in quasi-financial institutions and potential collusion or benefit transfer, which is not uncommon in China's financial market. As early as the People's Bank of China introduced the interim measures for the management of gold accumulation business, which clearly prohibited non-financial institutions from engaging in financial gold business. However, Yongqun Gold used consumer purchase contracts as cover, disguising wealth management products as physical gold transactions and intentionally blurring the line between buying and investing. Since gold is neither a standard security nor completely equivalent to a wealth management product, a gray area emerged between local financial regulation and central bank oversight. Additionally, Yongqun only had jewelry sales qualifications, but used the brand authorization plus physical retail franchise model to open stores in various locations. These franchises did not have financial licenses, but were effectively responsible for the sale of gold assets. The Wade was not on side without Yongqun gold sales and in customer fund management and rebate payments, thus forming a de facto branch financial institution. However, since it was registered as a retail enterprise, local market regulators failed to recognize its financial nature in time. Several insurance companies, such as Xing Insurance, People's Insurance, and Taiping Insurance, provided Yongqun with so-called gold asset protection policies, giving it a green light to its scam. These policies only cover logistics or loss-related incidents and do not assume responsibility for fund payment. However, ordinary investors mistakenly believe this was financial insurance with a lack of regulation, the failure of insurance agency to conduct due diligence, and the potential for benefit transfer. It raised doubts about whether there was collusion. In fact, it is a common scam across China for jewelry stores or gold investment platforms to suddenly close and flee, leaving customers empty-handed. In March last year, several franchise stores under Shandong Gold and China Gold also suddenly closed and ran away. It caused thousands of investors to lose contact overnight, unable to withdraw the funds they had invested, all the gold products they had purchased, ultimately leading to a huge loss exceeding million RMB. The furthest reaching impact of these scams comes from the complete collapse of trust. A societal trust crisis has spread from the financial market to broader areas. This is not just the bankruptcy of trust in a single platform, but a profound questioning and disintegration of the entire system and social relationships. First, it's the bankruptcy of trust in the platform. Many investors were attracted by Yongqun's offline store's upscale decor, uniform dress code, and even the ritual of sending gold bars, mistakenly thinking this represented strength and legitimacy. However, the truth ultimately proved that this was all just a carefully packaged scam. After this, even legally compliant institutions will find it difficult to easily regain investors' trust. Second, it's the collapse of trust in the system. Insurance policies issued by companies, promotions by well-known media, and standard complete contract documents were once seen as compliance guarantees. However, when the scam was exposed, these seemingly reliable endorsements all turn out to be empty. The regulatory system and enforcement capabilities were unable to substantively examine these actions in time, creating public anger.